Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I tell.
All right. Hey guys, my name is Mark Eitel, and you are locked in to the Mr. Mortgage Show. And man, we are super excited to be with you this week, and we are glad that you chose to spend a bit of time with us. We've got a great show lined up for you. We are going to cover a lot of ground. This is going to be a fast-paced show. Lots of headlines swirling around this week regarding a specific loan program. And we haven't seen that in a while, where one single program or one single topic, other than interest rates, getting so much attention. And guys, you might have seen the headlines out there, some good, some bad, and we're going to uncover the truth about the new 100% loan program. And some people are alluding to the 2008 housing crash, and oh my God, here we go again. So we're going to cover the good, the bad, and the ugly in that program, because it's getting a lot of press, but a lot of misconception. And that's where I like to jump in and just kind of cover the data, if you will, and take the emotion out of it. So we are going to dive into that. Hey, before we get started, if you have questions or comments along the way, guys, you know how valuable your input and your participation is to us. I say us because I am joined, as always, by Jen, my producer extraordinaire, who is running the board, answering the phone, responding to your emails and texts. She's doing it all back there, and I'm blessed to have her with me again this week. But if you have questions or comments, call or text the Anytime hotline. That number is 855-462-7292. That's 855-462-7292. That is the Anytime hotline. And we call it that because when we are not on the air bringing you the mortgage magic, that number forwards to my office. So you can get us just about any time on that number, 855-462-7292. Or you can head over to the new and improved MrMortgageRadio.com. That's MrMortgageRadio.com. And you will see a big orange button that says Get Your Questions on the Air. If you click that button, follow the instructions, your questions will pop up here on our end, and Jen will read them on the air for you. So pretty excited to have that tool. Pretty excited to clean up the website too. All the stuff we talk about, the different loan programs, the different news sources. If it's an article that we've written and was published in Newsbreak, that's up there as well. So lots of good stuff at MrMortgageRadio.com. But anyway, enough with the public service announcements. You know how to get us. You know how to find us. If you want to participate, we welcome you to join the show. So, hey, let's dive into that 100% program. And I'll tell you what really got me a little bit worked up. Firstly, I saw a piece on CNBC.com talking about the 100% loan program. And I thought it was interesting because it's being offered by United Wholesale Mortgage. And as the name indicates, they're a wholesale lender. So it's only available through their roster of approved mortgage brokers, which we're lucky to be one of them. So we have this program, and we've already been through the application process on a few loans with this program. So I feel like we've got a voice to speak on this particular topic because we've been through the process already. And people were excited but cautious, right? Because, oh my God, here we go again. 100% financing is available. Is this a housing bubble all over again, or lenders getting careless? Guys, it's not at all that. It's no different than a down payment assistance grant. Well, it's different, but it's structured the same way. So what I mean by that, you go through the approval process for a 97% loan. Just like any other 97% loan that's available out there, you've got to have the credit score, you've got to have the income, you've got to meet all of the underwriting guidelines with the exception of a 3% down payment, because United Wholesale Mortgage is going to give you a non-interest accruing second mortgage, almost like a grant. It's not a gift because you have to pay it back, but you pay it back with no interest, and you pay it back at the end when you either sell the property, refinance the property, or if you're lucky enough to win the lotto this weekend and pay your loan off, you would also have to pay off that second mortgage. So it does require repayment at sale, refinance, or payoff, but it doesn't accrue interest. What I mean by that is the balance never grows. So because the balance never grows, it's an interest-free loan. It's like borrowing the money from your parents and paying them back in 15 years. But it does require being paid back. The cool thing, which makes it very different and much easier than one of the grant programs, is it's their money that they're putting up. There's no cap on how much they'll loan in this second mortgage arena. Like, for example, Florida has Hometown Heroes. Well, Hometown Heroes runs out of money every time, and then you're waiting for the next replenishment. Matter of fact, I think it's July 1st of this year. There's $100 million available for Hometown Heroes. Well, that'll be used up by Christmas. And then you're playing the waiting game again. And with a lot of the grant programs that are funded by a governmental agency or a charity, require you to go through a buyer's education process, a grant review process. You're going through a quote-unquote class, and then you're certified, right? You're qualified for the grant. So your name goes on the list. You can get the grant. Now you go out and get the loan. There's at least two parties involved in most cases. Well, with this program, it's single source. So you get approved for your loan. The second mortgage is there. It's a very clean process. The downside is the interest rates are slightly higher with that 97% program, but it alleviates the need to have the 3% for the down payment. Now, I don't think this is a huge game changer for the market. Where I think it might help some first-time buyers, and nobody's talking about this, is that if that real estate commission rule goes in effect and buyers do indeed, out of their own pockets, have to pay for their representation, right, their own buyer's agent, and that fee is somewhere between 2 and 3% on average, well, guys, guess what? If you saved up the 3% for a down payment, but that's all you have, you don't have the money to pay your agent. Well, now a program like this will allow you to do both, because you can have that second mortgage as a down payment replacement, and then you can pay your agent with what would have been your down payment. So I think in that arena, it's going to be interesting to see how much difference it makes. That's the program in a nutshell. There were a lot of positive articles, but one, this really jumped out at me. CNN really should be ashamed of themselves for this article. It was written by Allison Moreau, CNN.com, and the headline says, "A shady financial tool from the housing bubble era is making a comeback." My God, if that's not clickbait and if that's not scaring people, guys, this 100% financing is not what crashed the market. In 2008, it was payment shock. All of those interest-only adjustable rate mortgages adjusted, and the interest-only period expired, and then the payment jumped double, triple what it started out as, and people couldn't make the payment. Then they were forced to sell. Everybody was trying to sell at the same time, and then there was no more of those shady loans that this headline is alluding to that were available for other people to step in and take out those mortgages with. So anyway, I hated that she said that. A shady financial tool from the housing bubble era is making a comeback. And throughout the article, she uses terms like, under the deal being peddled by United Wholesale Mortgage. That makes it sound like a scam in and of itself. And then she said, here's the catch, right? This is the big gotcha in the article. That $15,000 won't accrue interest, but it will need to be paid back in full all at once when you either sell the house, pay the mortgage off, or refinance. Guys, I don't know how that's not fair. I think that's a fair deal. If you're borrowing interest-free for up to 30 years, you should have to pay it back. So anyway, I wanted to get that off my chest because it's not the big, bad, scary monster that the reporters are making it out to be. It's really no different than a down payment assistance grant. It's just structured from a single source, and the process is a lot smoother. So I hope that helps. Guys, if you have questions about that, reach out to us. I'll be happy to walk you through the specifics. But in the meantime, you hear the music. You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And we are so excited that you're with us. If you have questions or comments and you want to get them on the air, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline. And Jen is womanning the hotline, and she will get your questions on the air. If you prefer, you can head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the page is a big orange button that says Get Your Questions on the Air. Just click that button, follow the instructions. They'll pop up on our end, and Jen will read them on the air for you. Again, that's MrMortgageRadio.com. And hey, I did see one text that came in while we were in the break asking what was that news app that I was talking about. Guys, we are now a contributor to the Newsbreak news resource app, and you can find that at newsbreak.com or go to the App Store on your phone and download the Newsbreak app. Search for Mr. Mortgage Radio as a contributor, and then you can see all the articles that we write in our daily column, and hopefully you save us as one of your favorite sources and participate. We get a ton of comments. Some of them are pretty colorful, but we're having a lot of fun with that. Again, that's newsbreak.com. But hey, I am going to throw it Jen's way to get some questions on the air. Hey, Jen, go ahead and throw me a question.
Cynthia sent us this. Can I get a mortgage with active medical collections on my credit? My score is a 672.
Hey, Cynthia, this is a really, really good question. There have been lots of changes around the credit reporting of medical lates, medical collections, and all of it's been in the consumer's favor. I mean, the credit reporting agencies know how difficult medical billing is. I mean, man, trying to understand some of that is like trying to figure out which pill to take when you're watching The Matrix. It can get quite confusing. So, but let me back up and answer your question. With a medical collection, you should be okay. Now, the good news is a 672 credit score. If you're using FHA, man, you're in the meaty part of the curve, so you should be fine. I just want to make sure we're talking about a collection and not a judgment, because the chronological order, if you will, is a late and then a collection and then a judgment or a charge-off. So just make sure it's a collection, because if it's a judgment, the answer could be different. But if you're using an FHA loan and you have medical collections, you should be okay. Although I would be much more comfortable answering this question if we had a quick conversation so I could better understand, and if I could see the collections, even if it's on a Credit Karma report, and get an idea of exactly what we're talking about. But to answer your question, you should be okay. So don't be discouraged. It's definitely worth taking the next step and having a conversation either with us or with another mortgage lender, especially if you're using an FHA mortgage. So I hope that helps. I'm here if you need me. Thank you for that one. Hey, Jen, throw me another question.
Yaz sent this text. My husband makes the money, but I have a better credit score. Is there a way to use his income but my credit?
Hey, Yaz, another great question. I wish, man, oh man, do I wish. And it's not uncommon that the wife has the better credit score, even if she's the one that makes the money, which is another thing that's not uncommon. So how it works is if two borrowers apply together, right, borrower and co-borrower, the lower of the two middle scores is what's used for underwriting in almost all scenarios. So as much as I would love to say yes, there's not a way presently to use just your score
and just his income. Now, I don't know what his score is. I would encourage you to at least have the conversation, because there are loan programs, especially in the FHA world, that have a wide range of credit score opportunity. Now, some of them may require a 5 or 10% down payment, depending on the score, but I would encourage you to at least have the conversation. And if you know the scores, that's helpful. You can just have a conversation over the phone to see if that score qualifies. So, guys, credit score, income, assets, and property are the four legs of any. You hear me talk about it all the time. The mortgage application is like a stool. If you've got all four legs, you've got a stable stool that you can jump up and down on. But oftentimes with just three of those legs, that stool will still stand. Now, with the lower credit scores, sometimes it's not the score that's the problem. It's the derogatory credit that's pulling the score down. So I would encourage you to have a further conversation. And to back all the way up and answer the question, if we're using both incomes, we're using the lower of the two credit scores. So hope that helps. I know it's not the answer you wanted, but I certainly appreciate you shooting us the question. Hey, Jen, can we squeeze in another question? Go ahead.
This one is from Kevin. I've heard you talk about gifting equity. Does this work on all property types? I'm considering selling my son a triplex.
Hey, Kevin, you guys are bringing great questions today. Man, oh man, everybody must have just charged up over the holiday break, and you're bringing the A game. So another great question. Guys, the gift of equity strategy is an awesome way for one family member to sell to another. And in often cases, you can work the math so that the buyer is not bringing any money to the table. It's really, really a great strategy. You're just gifting them the equity position or a portion of the equity position. Now, Kevin, to answer your question, if it's going to be a gift of equity, it's going to need to be his primary residence. And the good news is, up to 4 units, it can be his primary residence. And man, what an amazing gift if that's how this is shaking out. If you're selling him the triplex and he's going to move into it as his primary and collect rent on 2 of the 3 doors, what a great, great way to get started in homeownership and in building a real estate portfolio, because eventually he can move out and turn that into a rental property. So great, great question. The answer is yes, up to 4 units, as long as your son or whoever the recipient of the equity gift is going to use the property as their primary residence, meaning they're going to move in and occupy that as their primary in one of the units, and they can rent the rest of the property out. But great, great question. I hope that helps. And what a brilliant, brilliant way to help your son get started. Guys, this is a brilliant, brilliant strategy. Think about this for a minute. Kevin, man, good on you for putting your son in this position. He can own his primary residence that's generating maybe even positive cash flow, but certainly offset cash flow, and building equity in a property. And if the math shakes out, he can do this with no money out of pocket. Wow. I love this one. Thanks for that question. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Friends, if you have questions or comments and you want to get them on the air, just call or text 855-462-7292. That's 855 462-7292. That is the Anytime Hotline. Jen is womanning the hotline, and she'll get your questions on the air. Or just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the page, you can't miss it, there's a big orange button that says Get Your Questions on the Air. If you click that button, follow the instructions, your question will pop up on our end, and Jen will read it on the air for you. Hey, but without further ado, let's throw it to Jen and keep those questions coming. Hey, Jen, when you're ready, go ahead.
Nelson sent this. Can I buy an investment property if I don't own a home? I currently rent and have been looking for a place, but I found a great deal on an investment property.
Hey, Nelson, this is a great question, my man. Yes, you can. So if you're going to use the landlord loan or a DSCR loan, make sure that you are intending this to be a rental property, because there is an occupancy disclosure in the package that clearly states you're buying this to rent. You're not buying it to occupy. But you don't have to own a primary residence first. You can buy the rental property before you buy the primary. And we've seen this happen on several occasions, especially during COVID. There were several people who were renting a place, and the landlord said, hey, I'm going to capitalize on this crazy market. I'm going to sell. Do you want to buy it? And the tenants, well, I would buy it as an investment. I don't want to buy it to live in. And they bought the property as an investment property, moved out, rented it out, followed all the rules. But I've seen that happen where people are renting until they can buy and had the opportunity to buy the unit that they were renting. So I hope I didn't confuse you, but I just wanted to share that example because you're not alone. It's happened before, and it happens often, especially when you're out there looking. You might find an opportunity to buy an awesome rental property. So great question. And the answer is yes, you can buy an investment property if you don't currently own the primary residence. Just keep in mind, there's that occupancy affidavit that's in all of the DSCR loans. So some people do try to bend the rules, and I'm not suggesting this is you, and use the DSCR loan as a way to do essentially a no income verification loan, because the landlord loan, we use the rental income or the projected rental income if it's vacant of the property to underwrite the mortgage, meaning your income is not analyzed, just the property's income. So if we're not looking at your income and that property is no longer a rental, it's really your primary, there's no way to know that there's income there to support it. So some people try to slide one under the fence and call a primary an investment property. And some people call that reverse occupancy fraud, because occupancy fraud traditionally is when you're buying a property and calling it your primary and you never intend in living in it. In this instance, you would be buying the property, calling it an investment property, but always intending on living in it. So just be aware of it. Occupancy fraud is a real thing. And as the market has slowed down, more and more files are being audited. So, but to answer your question, I'm sure you're not one of these guys that are trying to circumvent the rules. Yes, you can buy the investment property first. Great question. Hey, Jen, throw me another question.
Veronica emailed this one. I see mortgage rates coming down a little, but the equity line rates are still high. When will they start coming down?
Veronica. Who was that? Elvis Costello? Veronica. Anyway, clearly my singing has gotten no better in the new year. Interestingly enough, mortgage rates aren't tied to prime or what the Fed moves, right? The Fed moves the overnight rate, which is directly tied to the prime rate, which is what equity lines are tied to. So until the Federal Reserve starts lowering rates, if you believe that's going to happen, that's when you'll see credit card rates come down, HELOC rates, home equity lines of credit, come down. But until the Fed starts cutting, that's not going to happen. And actually, this is a really good segue, if you will. We're seeing more and more people who were thinking of an equity line to pay off debt, realizing that the equity line interest rate is 10%, 11%, 12%. They can do a debt consolidation refi, use our rec refi, for example, and pay debt off and have an interest rate of 6.5 or 6.25 with a slight buy down. My point is that blended rate calculation with that equity line up there at 10 or 12% is causing some people to rethink that strategy and just dive into a rec refi. And I'm not suggesting that's right for you, and I'm not suggesting that's underlying your question. I'm just tossing that out there because we are seeing that happen. So great question. I know it's super confusing. We see mortgage rates move, but we don't see equity line rates move or vice versa. And it's just an interesting world. They all have a tendency, typically, long-term trends, to move together, but they're influenced by very, very different things. So we have these circumstances that we're in right now where mortgage rates have pulled back and no other debt has had any easing in rates. So brilliant question. If you want to dive deep on that, call me off the air. Guys, I geek out on this stuff. I love talking about it. So if anybody has questions, please reach out. I'd love to have a conversation. Hey, Jen, let's get another question on the air. What do you have?
Corey sent us this. Who pays for a construction loan while the house is being built? Is it us or the builder?
Okay, Corey, great question. Man, I'm really impressed with the questions we've gotten today. You guys are bringing the A game. I said that once before. I'm really impressed. So, to answer your question, nobody. Well, let's back up. If you have a one-off builder, like a small custom home builder, not like a big tract builder, you can get the mortgage in your name with them as the builder. Nobody is paying that mortgage during construction because there is what's called an interest reserve built in to the loan amount. So during construction, it only requires interest payments. So let's use round numbers and say there's a $100,000 loan and 10% interest. And it's going to take a year to build. So that's $10,000 in interest if all of the numbers stay round. And I know they don't, but for illustration, the loan would have a $10,000 interest reserve. So in that example, the loan would be for $110,000 with that $10,000 being in there to service its own debt. So it's self-servicing debt until the property is CO'd, right? Certificate of occupancy, all the final inspections, and then you convert to, most commonly, a 30-year fixed rate mortgage. So you'll close on the construction loan and then convert to a mortgage. And at that point, payments are required. Now, when I mentioned not one of the big tract home builders, those guys operate a little bit differently. They've got a master line of credit and they're servicing that debt. But if you're doing a construction perm loan and you're using a smaller one-off builder, that interest reserve is built in. So in none of these instances are you paying the payments during construction. So I hope that helps. We're seeing more and more people looking to new construction, whether it's the tract home builders, the big builders, because they can offer incentives, they can buy your rate down. That's great. But there are others who say, hey, I want to live in this awesome neighborhood. I found a lot. I paid cash for the lot, or I put a big down payment down on the lot. I found my builder because I can't find the home I'm looking for in the neighborhood I want to live in. So I'm just going to build it. And we're seeing more and more interest in the construction to perm loan. Guys, if you have any questions regarding construction perm, who pays, when they pay, how much you can borrow, is the lot equity, just call me or text me. I'll be happy to have a discussion with you. I grew up in a family of home builders. I love this stuff. And I love the idea of building the home you want, the way you want it, where you want it. I think that's a great opportunity if you can pull it off. That's a great question. One of my favorite topics, the old custom home builders. Anyway, guys, you hear the music. You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we're back. My name is Mark Eitel, and you are locked and loaded right here on the Mr. Mortgage Show. Man, I am so excited that you chose to spend a bit of your day with us. If you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 462-7292. That is the Anytime Hotline. And Jen is womaning the hotline, and she'll get your questions on the air. Or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page is a big orange button that says Get Your Questions on the Air. It's all super self-explanatory. Just click that orange button, follow the instructions, and Jen will read your question on the air. Hey, but speaking of Jen reading questions, let me throw it to Jen right now.
Sal wants to know, I make plenty of money and can afford around a 50% down payment, but my credit is a little shaky since my divorce. It's in the 600s. Is there a mortgage that would work for me? The house is around $500,000.
Hey, Big Poppy. Sal, I make plenty of money and I got money in the bank. You shouldn't have a hard time finding a new wife, brother. Hey, all kidding aside, great question. So the three-legged stool and the four-legged stool. That's right. I'm bringing that analogy out, and it's not even dusty because I used it earlier today. Guys, income, assets, credit, property. Those are the four legs of the stool, right? Super stable stool. All four legs are there. A three-legged stool will also stand. A little shaky, but it'll stand. And Sal is the perfect example. He's got the income. He's got the assets. We're going to assume that the property appraises for $500,000. So that's the third leg. The fourth leg, which might need some attention, is the credit score. Now, the good news is a credit score in the 600s, you certainly would qualify score-wise for FHA. Now, you heard me say earlier, sometimes it's not the score, it's what's on the credit report that's pulling the score down. That might be an issue. But to answer your question, Sal, you may not have to put 50% down. If that's your goal, you certainly are broadening your opportunity with more and more loan programs, the lower the loan to value. And as long as we can document that income, I don't see a challenge. Now, I say that, guys, I say that without having seen the credit report because credit score is important, but it's only part of the equation. What is posting on the credit report that's making up that score? So that's my only hesitation. But Sal, I think you got a lot to work with, my man. And ladies, if you're looking for a big spender, Sal may be available. No, I'm kidding. I'm having fun with you, brother. I appreciate the question. I'd welcome the opportunity to have a conversation off the air just to get a better understanding of the credit component. But it sounds like you have three of the four legs and probably stand a pretty good chance of getting that mortgage. So if you'd like to talk, reach out. I would love to have a quick conversation with you and see if we can't figure this out. Hey, Jen, throw me another question.
Samantha sent us this one. I've seen a few homes listed as rent to own. They're not with a company, just a regular person, so I'm a little nervous about being scammed. How does this typically work? I mean, does part of the rent go towards a down payment?
Hey, Sam, this is a great question, and you are right to be concerned about a scam. Just Google rent-to-own Craigslist scams, and you'll see. With that being said, there are a lot of good people that offer the rent-to-own strategy. I'm thinking of my friend John, who sold several properties this way, and it's a great way, if you're not credit ready, to get the house that you want and build up either your credit score over time. What's keeping you from being mortgage ready right now? You have that time to work on it. And in a lot of instances, a portion of your rent payment does go to your deposit, but all of that has to be spelled out up front, and you'll want that held in an escrow account every month. So if you're going to do this and it's private individual and private individual, I would strongly suggest talking to a real estate attorney to draft the document up to protect both of you. So the landlord typically will apply a small percentage of the rent towards a future down payment, and you could have built into the agreement, say after 12 months or after 24 months or after 36 months, a set price and a set amount of down payment built up in this escrow account for you to pull the trigger on the transaction. Most of the time it's around a 3-year, I don't want to say option because I want to explain what a lease option is, but usually it's somewhere between 1 and 3 years is the purchase portion of the rent to own. So just throwing that out there.
Lease options feel very similar to a rent-to-own, but they're typically all of the rent payment goes to the landlord, and you've agreed to a predetermined price at a predetermined date. So it could look something like a $2,000 a month lease payment, and after 12 months, I'm paying $350,000 for the house. And if I go past that period of time, I'm given the opportunity to renew, and it's another $2,000 a month. And after 24 months, I'm paying maybe $20,000 more. There's usually a step-up appreciation in a lease option. But lease option is I'm renting it from you, and we've determined a price and a date. You'll let me buy it. Rent-to-own is more along the lines of the way you described this, where a portion of your rent goes towards your down payment. Now, that's not always the case. That's why I suggest having an attorney draft it up, and the attorney could even collect the rent payment, put a portion of it in their escrow account on your behalf, and pay the landlord the balance. But it's a great, great strategy to get the property now and get yourself mortgage ready. So I love this question. I appreciate it. And again, happy to dive deep with you if you'd like to have a conversation off the air. Hey, Jen, let's get another question in.
This one is from Kenny. Are we limited to the type of debts we can pay off with the rec refinance? I really want to pay off everything. Me too, Kenny.
Me too, Jen and Kenny. Hey, great question, my man. Great question. Assuming you have enough equity, you can pay off everything. You're not limited to a certain type of debt that can be paid off. You're limited only by the equity that you have. So if you have a house that's $1 million and you owe $600,000, you could borrow $800,000, pull $200 out to pay off all your debts. So I hope that helps. The equity portion is what's going to dictate what can be paid off. And one very, very cool thing about a debt consolidation loan is those debts can be taken out of your debt to income calculation now, knowing they're going to be paid at closing. And that's another reason we talked a little bit earlier about equity line versus debt consolidation in instances like this. With an equity line, you can't take those debts out of the equation. With a rec refinance or a traditional debt consolidation home refinance, you can. And that broadens your chances of approval, because if you've got a $500 car payment and an $800 credit card and $2,000 on the boat, well, guess what? If all that's getting paid at closing, all that debt can be taken out of your calculation now, which a lot of people find super, super helpful. So great, great question. All right, Jen, let's try to squeeze in one more. I'm feeling lucky.
Harry has this question. If we take a reverse mortgage, who pays the taxes and insurance? We don't currently have a mortgage.
Hey, Harry, this is a great, great question. You do. You're responsible for the insurance. You're responsible for the taxes. You don't have to make a monthly mortgage payment. That accrues. So your balance is growing. All of those payments are deferred until the end of the loan period. But the taxes, the insurance, any maintenance, and any association dues, if there are any, have to be paid by you. And in a lot of instances, people aren't prepared for this. You may have to increase your insurance amount because it's going to be based on your new loan amount. And that's another thing we're seeing a big uptick in interest in is the reverse mortgage, because for the right person, in the right scenario, it can be life-changing. It's not right for everybody, guys. I say it all the time, but it's a powerful tool to take the financial pressure off each month and allow you to enjoy some of that equity now. And Harry, there are so many moving parts to a reverse mortgage that I would invite you to give us a call. I would love to jump on the phone with you, spend as much time as you need just to walk you through it, because not only are there a ton of misconceptions, there are a lot of confusing parts about the reverse mortgage. And I'm a big fan of the product, but again, it's not right for everybody. Hey guys, you hear the music? Man, oh man, that was fast. You know what that means? We have come to the end of... Guys, if you need us, When we're not on the air, check out MrMortgageRadio.com. That's the easiest way. Everything's there. MrMortgageRadio.com. One more time for you in the back. I see you trying to write this down. MrMortgageRadio.com. All right, guys, have an amazing week. Jen and I will be back next week right here, same time, same station.